Thank you for the invitation. It's great to be here, although I do come here quite a bit, having a very strong connection with a great local startup, being the CEO of Infogram. Before Infogram, my longest professional past comes working with Google, and since then I've been on both sides of the table, both on the investor side and the entrepreneurial side of the startup equation. So I'll try to give you this kind of a higher level perspective. And the title that you may see in your agendas could be even more grandiose than the one you see on the slide now, but I'll bring together this kind of a trio of a triplet of important actors and dynamics in the startup market. And I'll also try to do it fast because I'm between you and coffee. So first we'll start with a short story, though. It's the story of an entrepreneur some time ago, a guy with an idea for a real blue ocean strategy. This was some time ago, so starting a startup was much more expensive then in terms of cost of equipment and so forth. And he was going after meeting potential investors and sponsors all around Europe, until he finally found alignment with a pair of funders who needed to see his idea happen. And his pitch was very simple. It was, give me a few ships and a few dozen men crazy enough to sail with me to the west, where we'll go until we reach Asia. And that guy was, of course, Christopher Columbus. And his startup idea was disrupting the Silk Road trade that had been going on for a couple of centuries now by finding a new navigational route to Asia. His investors were King and Queen of Spain, Frederick and Isabella, who had recently reconquered the Iberian Peninsula back from Moorish occupation, and who had, because they'd been busy, didn't really have a proper stake in the Far East Asian trade, so they needed to see this happen. So they had a strong aligned interest there. I'm sure they saw some risks there. For example, maybe this guy is crazy and he will sail off the edge of the world because it's actually flat and not round. So, you know, those kinds of existential risks, I'm sure, were considered. Royalty invested in different things, of course. You would, as a king, invest, for example, in your court to make sure that people around you are happy and you don't get assassinated. You would invest in taxing the little people, of course, a stable, although a small source of income. You would invest in your real estate, keeping your fortifications and castles in order. You would invest in conquest and war. Still a pretty popular tactic in some places, because there's potential of a big upside there. And then you could also place small bets in these more kind of exploratory activities, quite literally in this case. So today we, of course, have the advantage of having portfolio theory at our disposal, and that's what a portfolio centuries ago could have looked like for somebody who had the assets to have a portfolio in the first place. Portfolio theory is, in a nutshell, it's an idea that in order to protect your investment and protect the upside of the investment as well, depending on your investment horizon and risk profile, you have to diversify into different kinds of instruments that then themselves have different risk profiles. So in this case, if the market is extremely bearish, if investors and markets are pessimistic, and investor interest goes toward the more stable, lower risk but lower return instruments, you are protected in terms of your relative upside to the market situation. And vice versa, if markets are very bullish and investors are optimistic, it could be that outsized returns can be made in the riskier end, in the higher return end. And we're, of course, interested in the tech startups side of this equation, because there we can find these outsized returns, high risk, high return opportunities. So today's kings are asset managers. So these are people who, and institutions of course, who manage large pools of funds. And this is relevant even for the lower end of investment here, which could be your early stage funds, for instance, in that these the higher funds in the hierarchy invest in these smaller funds that then take bigger risks, for instance. So the money for startups, of course, comes from the investors, like Sean just presented here, but it doesn't all come from Sean's pocket, surely, right? Okay. The early stage funds such as Point 9 Capital, who is one of Infogram's investors, who I just have here because I know them, they don't condone any of the content here in any way, have investors from perhaps wealthy individuals, family funds, other funds of funds, who then diversify their investments downwards. And that means that what the early stage fund needs to do is they need to invest in these high risk, high return opportunities. Because every startup that gets to the level of success being defined as an IPO or a big exit, for example, has to be filtered up from that level of this initial pool of lots of opportunities, at which point it's very difficult to say how probable it is that they will be a winner. And that's the reason why, and these kinds of target returns and sizes of investment here are just ballparks, just to give you an idea of what an investor at that level has to be looking for. So at the seed level, an investor could be, for example, looking for a return of 20 to 30x of their investment in a single startup. And notice that you can't average this out. So you can't go like, okay, I'll invest in 20 startups, and one of these is going to be huge, and so the rest, the 19 can be like, because, well, you don't know, right? The thing is that we have, you can't apply an average probability to a single case, which is just simple probability theory. So risk. What is risk? From the mouths of Babes and Warren Buffett, you shall hear the truth. And risk is not knowing what you're doing. And this applies to both startups and investors. So Warren Buffett doesn't like risk. He invests in opportunities where he can analyze the situation very closely, where he can look at the market dynamics, where he can look at the competitive situation, the management team, and so forth, and have as much information about that as possible. And so in his case, he looks for undervalued opportunities. Information, even in an efficient market, information is never perfect. But if you can find imbalances in information, you can find opportunities for higher returns. So with startups, of course, the instrument, startup as an investment instrument is at the very top end of the risk curve compared to all of these other instruments. And even inside of startups, there are then differences in risk. So if we plot, I mentioned market information, so if we plot current information as a stable line, and then potential perfect information, or at least information that we need in order to make an opportunity successful, we can analyze some of the differences in kind of risk profiles of startups. So for instance, applying an existing business model in an existing market, such as Rocket Internet does with some, has done, for example, with an e-commerce company. They see an e-commerce business model working well. They take that more or less as it is, modify it a little bit, and launch that in a new geographical market. It's still a bit risky, but you're still pretty close to those differences in information in that sense. Applying a existing business model in a new market is a lot more challenging, such as, say, Airbnb applying the sharing economy business model to the rentals market. Applying a new business model in an entirely new market is even riskier, and it's very difficult to say like what's coming out of there. Say, trying to evaluate somebody like Google 17 years ago could have been a case like this. A very nascent search engine market, non-existing content targeting and search targeting advertising business model. Nearly impossible to evaluate. Of course, there's going to be people who said, like, yes, 15 years ago I knew that Google is going to be huge. And if they're billionaires, you can believe them. But if not, then maybe not. But it doesn't actually end here. Like there are even higher risk, higher return opportunities that you can imagine, such as like interplanetary colonization. And you can let it sink in for a while that this is not an imaginary example, but there's actually people working on this and being invested in who are trying to figure out colonization of Mars. So, as an entrepreneur, your job is to take risk, because that's what you represent in the overall picture of the investment landscape. With, this is of course a gross characterization, but this holds in most places that we've analyzed. Risk is not knowing what you're doing, but you can still find patterns in the opportunities that you have. We looked at some of them in terms of the business model versus market in existence or not. And one of the other patterns that these big return business models have is that they both create and destroy value at the same time. So that's often what disruption does. It creates value by destroying value in some cases. So that's what Columbus aimed to do by disrupting the Silk Road trade. This is what Google did in a slightly different economic format by basically wiping out the value of OEM mobile device manufacturers' operating system business. If you were Samsung or HTC at this point, it made really no sense to come up with your own operating system. I don't know exactly how this thinking came about, but I'm pretty sure it wasn't to counter Apple. Google has always been very conscious of competing against Microsoft, because Microsoft is a key gatekeeper, has been for a long time and still is. And maybe, I don't know if this has happened, but maybe at some point inside Google, they went like, okay, if this was year 95, Microsoft was just launching their new Windows operating system, how would we counter that? Well, we should create one that's at least as good and give that away for free. At least that's what they did with Android. So basically, whenever you're able to wipe the table with Microsoft in the operating system market, you're doing something right. That's how Android created this economic moat for Google with value destruction. And that's what Uber is doing with the taxi industry. Uber and its closest competitor, Lyft, I believe, are disrupting the taxi industry, creating value for themselves, but also, if not destroying, at least disrupting value in the current existing ecosystem of multiple taxi companies. They're doing that everywhere in the world and will do it also here in Latvia, of course. Trust me. This is an interesting dynamic in the tech industry, is that we're often told that the winner takes the biggest piece of the pie. And in the mobile app economy, of app developers who are interested in creating revenue, 90% of them are making less than 100K a month. Now I can get you the references for these surveys and so forth, but this was a survey of 8,000 app developers, more or less. And there's this interesting idea that this movement behind everybody should learn to code is partially motivated because it democratizes access to launching new products and launching new businesses and being a part of this creative class. Only 10% of these kinds of app makers make more than 100K a month, and it's actually even more dramatic in that over half of them make less than $1,000 a month of app makers who are interested in revenue, which means that's basically hobby level. 5% make more than $500,000 a month. So this is a pie chart version of a very classic income distribution curve, where you have a long tail of low and middle earners and a narrow but high concentration of high income or high wealth concentration at the end. So it's the new economy with good old rules. So with this dynamic, I want to challenge a little bit the party line that we have going on here. Sean went over some very important signals about how to raise funding. My absolute favorite, which he alluded to as well a little bit in terms of signals, my absolute favorite for raising capital is the following. If you want to get a few $1 million for your startup idea, the best way to do it is to have an exit of a few $100 million already under your belt. because then you have money coming in through doors and windows, because that is a very strong signal. Remember, the early stage investors have to sell these opportunities to their partners, but also to their LPs, their limited partners, called limited partners because they're limited to just giving money into the fund and so forth. So this is actually kind of a perverse dynamic, because we'd like to think that this is it would be an easy to access market, but indeed, if you already have value, wealth even, concentrated around you, it is much easier to get more of that value. Because money goes where money grows. Money is very loyal in that sense. Money goes where talent grows only if other things are equal, or because talent is a huge unfair advantage in this case. And this doesn't make sense to show in the pie charts, but this is still about the app economy. The top 1.6% of app makers make multiples and multiples over the remainder of that huge pie over there. And these are the supercells and kings of the app world. And that's why it doesn't make sense to aim anywhere lower than the very top. That's why, as an entrepreneur, you have to go after the high return opportunities, even if that means taking high risk. So, what do you need to take risk? What are the patterns in risk taking? So, of course, you need appetite for risk, but that's not enough, because you could have all the appetite for risk in the world, but if you don't have risk tolerance, that's no good, because if you end up on the street because you can't meet your financial obligations, you can't obviously run the startup, and the investment is moot. So this is another dynamic that you may not want to hear, but we should be aware of. There are two sizable studies about this. The second one confirming the first one because people didn't want to hear those results. But what's the strongest signal for the success of a first-time entrepreneur? It's not the education they have, it's not the school they went to, not the grades, not the company they worked for in the past, but other things equal, with two entrepreneurs going after a similar opportunity, the one from the wealthier family will be likelier to succeed. Why? Because they have a higher tolerance for risk. They can keep doing that for a while. Now, there could be other dynamics there. A wealthier family can indicate better access to education, better access to contacts, and so forth. But yet, that's another dynamic of wealth concentration that's happening with, not only with tech startups, of course, but elsewhere. But with tech startups, this is extremely important, because there are other dynamics like this, and because the cycles in the tech industry are so fast. Let's take aviation as an example, another industry close to Latvia's heart. If you have an aviation startup, if you start an airline and you make it a success and you sell it and you exit, you will probably invest some of that money back into the aviation industry. That's how industries grow, right? Tech is a specialist industry. If there's a big exit in technology and there are dozens of people who make 10 million plus, a lot of that money will be invested back into the tech industry. So it feeds itself. But unlike aviation, the cycles in tech industry are so much shorter. They're really, really fast. So you can have billion-dollar companies growing up in less than 2 years, which means that cycle of success and reinvestment is so much faster than in other industries that tech will, without a fault, have and today has the potential of creating the new kings of this kind of investment landscape. To wrap up and to get us to coffee, let's revisit Columbus quickly. So what happened? So he aimed really high. He definitely went for a high-risk, high-return opportunity. But he was not, what shall we say, a lean startup entrepreneur, right? He didn't really see, he aimed high and he landed somewhere else, like literally landed somewhere else. And he couldn't actually recognize the opportunity beneath his feet for what it was. Very headstrong, very determined guy who then, for various reasons, got into fights and was arrested and sued by his investors and died alone, disowned, still thinking that he had discovered Asia. That's of course a cautionary tale. That's just to caution about that's just one problem that you can have if you aim for a high return opportunity that you don't know very much about, is that you have to keep navigating all the time. But within the scope of this presentation, we won't have time to go into lean startup methodology that much. So to summarize, as an investor, you are looking for unfair advantages. As an entrepreneur, you should be knowledgeable that this is what you should be offering. You should have some kind of an unfair advantage that you can offer for the investors. And if you work in government or work in other types of startup ecosystem support dynamics, be aware of these industry dynamics of risk, return, and of the dynamics of money, because money goes where money grows. And I'm happy that even if I deviated from the party line, my microphone still worked to the end. Thank you.